It was once one of the most powerful companies in America, praised as an innovator, trusted by investors, and worth billions on paper. But behind the scenes, Enron was built on lies. When the truth came out, it became one of the biggest corporate frauds in history, wiping out fortunes and destroying thousands of lives. In this video, we're uncovering the shocking rise and catastrophic fall of Enron, from its clever schemes to the scandal that shook Wall Street. And trust me, the way this fraud was exposed will leave you stunned. Before we dive in, don't forget to like, subscribe, and tap the bell. Because in the world of business, the biggest success stories can sometimes be the darkest lies. The rise of Enron. Founded in 1985 through the merger of Houston Natural Gas and Enron, Enron initially operated as a traditional natural gas pipeline company. Under CEO Kenneth Lay and later Jeffrey Skilling, the company transformed into an energy trading powerhouse. Enron pioneered the concept of trading energy as a commodity, creating markets for electricity, natural gas, and other energy derivatives. By the late 1990s, Wall Street analysts praised Enron as an innovative company that had revolutionized the energy sector. The stock price soared from $20 in 1990 to over $90 in 2000, making many executives and employees paper millionaires. The accounting tricks. Enron's financial success was largely an illusion created through sophisticated accounting fraud. The company used special purpose entities, or SPEs, to hide debt and inflate profits. These off-balance sheet partnerships allowed Enron to transfer liabilities away from the main company while booking immediate profits from transactions with these entities. Chief Financial Officer Andrew Fastow created hundreds of these partnerships with names like LGM and Raptor. Through mark-to-market accounting, Enron could book projected future profits from long-term contracts immediately, even if the actual cash flows were years away. This practice allowed the company to show impressive quarterly earnings growth that satisfied Wall Street expectations. The warning signs? Several red flags emerged that should have alerted investors and regulators to Enron's problems. The company's financial statements became increasingly complex and difficult to understand. Enron's debt-to-equity ratio was much higher than reported because of hidden liabilities in SPEs. Some analysts and short sellers, including Jim Chanos, questioned how Enron actually made money and why the company's cash flow didn't match its reported earnings. Bethany McLean of Fortune magazine published an article in March 2001 titled, "Is Enron Overpriced?" questioning the company's valuation and business model. When pressed for details about their operations, Enron executives became defensive and evasive, dismissing critics as simply not understanding their innovative business model. The collapse. The beginning of the end came in August 2001 when CEO Jeffrey Skilling abruptly resigned, citing personal reasons. In October 2001, Enron reported a $618 million quarterly loss and announced a $1.2 billion reduction in shareholder equity related to SPE transactions. The Securities and Exchange Commission launched an investigation into Enron's accounting practices. Credit rating agencies downgraded Enron's debt to junk status, triggering clauses that required immediate repayment of billions in loans. Unable to meet these obligations, Enron filed for Chapter 11 bankruptcy on December 2, 2001. The stock price, which had traded above $90 just a year earlier, fell to less than $1 per share. The human cost. The collapse of Enron in late 2001 was not just a corporate scandal. It was a human tragedy that shattered the lives of thousands of ordinary workers. Virtually overnight, roughly 20,000 employees lost their jobs, many of them learning of their termination from news broadcasts before receiving any official notice from the company itself. What made the blow even more devastating was that their financial futures were tied directly to the company's fate. Enron's 401 retirement plan was heavily concentrated in company stock, which had been aggressively promoted to employees as a safe investment. Workers were encouraged, and in some cases pressured, to put their savings into Enron shares, creating a dangerous over-reliance on the company's success. To make matters worse, during critical blackout periods, Employees were prohibited from selling their stock, while top executives quietly dumped their own shares, pocketing millions before the collapse. When Enron's fraud was exposed, the stock became worthless, wiping out the retirement savings of countless families in an instant. The fallout was catastrophic for long-serving employees who had dedicated decades of their lives to the company. Many retirees who had faithfully invested their pensions into Enron's stock lost everything they had saved. Workers in their 50s and 60s, too young to retire but too old to easily restart their careers, found themselves jobless, broke, and facing an uncertain future. The legal aftermath. The Enron scandal led to one of the largest corporate fraud prosecutions in U.S. history. Kenneth Lay was convicted on multiple counts of fraud and conspiracy, but died of a heart attack before sentencing. Jeffrey Skilling was sentenced to 24 years in prison, later reduced to 14 years. Andrew Fastow received a 6-year sentence after cooperating with prosecutors. The accounting firm Arthur Andersen, which had audited Enron's books and destroyed thousands of documents, was convicted of obstruction of justice and effectively ceased operations, eliminating 85,000 jobs worldwide. The scandal also brought down other executives and led to investigations of similar accounting practices at other major corporations. Regulatory changes. The collapse of Enron in 2001, once the 7th largest company in the United States, sent shockwaves through the financial world and became a defining moment in corporate history. The scandal revealed not only massive accounting fraud, but also deep flaws in corporate governance and the auditing profession. In response to the public outrage and the loss of investor confidence, lawmakers introduced sweeping reforms aimed at restoring trust to the financial system. The most significant of these reforms was the Sarbanes-Oxley Act of 2002, SOX, one of the most comprehensive corporate governance laws ever passed in the U.S. The legislation established new standards of accountability for executives, requiring CEOs and CFOs to personally certify the accuracy and completeness of their company's financial statements. This provision made top executives directly responsible for misconduct or misrepresentation, raising the stakes for corporate leadership. SOX also created the Public Company Accounting Oversight Board, PCAOB, to regulate and oversee auditing firms. This broke from the past system of self-regulation and ensured that auditors themselves were held to stricter standards. To reduce conflicts of interest, the law imposed much tighter restrictions on the types of consulting services auditors could provide to their clients, reinforcing the independence of the audit process. From fake profits to shattered pensions, the Enron scandal proves that corporate greed can ruin lives far beyond the boardroom. What shocked you the most about Enron's downfall? Share your thoughts in the comments. I'd love to hear your reaction. If you enjoyed this deep dive into one of history's biggest corporate scandals, hit like, subscribe, and share this video with someone who follows business drama. Until next time, stay curious, stay cautious, and never stop questioning the truth behind the numbers.